Corporate bonds are debt securities issued by corporations to raise capital for business operations, expansion projects, acquisitions, or refinancing existing obligations. When investors purchase corporate bonds, they effectively lend money to the issuing company in exchange for periodic interest payments and repayment of principal at maturity. Corporate bonds are an important source of long-term financing and play a critical role in global capital markets. Bondholders typically have priority over shareholders in the event of liquidation, making bonds generally less risky than equity investments. The program emphasizes corporate bond analysis because these instruments expose investors and financial institutions to interest rate risk, credit risk, and broader market conditions. Corporate bonds can be classified into several categories based on their structure and features. Secured bonds are backed by specific collateral, while unsecured bonds, often called debentures, rely solely on the issuer's creditworthiness. Callable bonds allow issuers to redeem bonds before maturity, usually when interest rates decline, while putable bonds give investors the right to sell bonds back to the issuer under specified conditions. Convertible bonds may be exchanged for equity shares, providing investors with potential upside participation in the issuer's stock performance. Bonds may also vary by maturity, coupon structure, seniority, and repayment terms. These characteristics influence pricing, yield, and risk exposure in fixed income markets. Credit risk is one of the most important risks associated with corporate bonds because it reflects the possibility that the issuer may fail to meet interest or principal payment obligations. Credit risk depends on the issuer's financial condition, cash flow generation, leverage, industry conditions, and overall economic environment. Credit rating agencies such as Moody's, Standard & Poor's, and Fitch evaluate issuers and assign ratings that indicate default risk levels. Investment-grade bonds are issued by financially strong companies with relatively low default risk, while speculative-grade or high-yield bonds carry higher risk and offer greater yields as compensation. Credit spreads, which measure yield differences relative to government bonds, reflect market perceptions of credit risk. Event risk refers to the possibility that unexpected corporate events may negatively affect a company's ability to repay debt or reduce the value of its bonds. Examples include mergers, acquisitions, leveraged buyouts, restructurings, litigation, regulatory actions, or sudden declines in business performance. Leveraged buyouts are particularly significant because they often increase corporate debt levels substantially, weakening credit quality and increasing default risk. Event risk can lead to sudden credit rating downgrades and widening credit spreads, causing bond prices to decline sharply. Investors therefore monitor corporate actions, governance decisions, and financial strategies closely to evaluate potential event risk exposures within bond portfolios. High-yield bonds, commonly called junk bonds, are speculative-grade debt securities issued by companies with lower credit ratings and higher default probabilities. Because of the greater risk involved, high-yield bonds offer significantly higher interest rates than investment-grade bonds. These bonds are often issued by companies with substantial leverage, weaker financial positions, or limited operating histories. High-yield bonds may provide attractive returns during favorable economic conditions, but they are highly sensitive to economic downturns, credit market stress, and liquidity conditions. Investors in high-yield bonds must carefully assess default probabilities, recovery rates, and macroeconomic trends because market volatility can cause substantial fluctuations in bond prices and yields. The program highlights corporate bonds and credit risk analysis as essential components of fixed income risk management. Corporate bond markets are deeply interconnected with banking systems, equity markets, and broader economic conditions. Understanding bond structures, credit ratings, default risk, event risk, and high-yield market dynamics is therefore critical for financial professionals responsible for portfolio management, credit analysis, and regulatory risk assessment. Effective management of corporate bond exposures requires continuous monitoring of issuer fundamentals, market liquidity, interest rate movements, and economic conditions. As global credit markets continue to evolve, mastery of corporate bond risk analysis remains fundamental for managing financial stability and investment performance.